If you're watching this right now, pause, put the phone down, turn off the background noise, look at the screen, because something just shifted, and most people are too distracted to notice it. For 70 years, global finance operated under one simple rule: the United States was the center of gravity. When America moved, markets moved. When Washington borrowed, the world lined up to lend. When Wall Street coughed, everyone else caught pneumonia. That was the rule. This morning, that rule cracked. If you're staring at the market numbers thinking they look backward, they're not. For the first time in modern financial history, momentum isn't flowing through New York, it isn't anchored in Chicago, it's consolidating in Toronto, and the reason is bigger than headlines. Donald Trump believed he could pressure Canada: tariffs, threats, trade leverage. He assumed Canada would fold. He assumed size equals power. But instead of reacting loudly, Canada moved quietly, strategically, decisively. And while Washington was focused on confrontation, Ottawa focused on stability. Today, we're talking about something that almost never happens: global capital, the trillions controlled by sovereign funds, pension giants, and central banks, is reassessing its default assumption that the United States is the safest place on earth to park money. That's not emotion. That's math. Yesterday, a report from the Financial Stability Board in Basel, normally ignored outside central banking circles, changed the conversation. For the first time since comparative scoring began, Canada's systemic stability rating edged above the United States. In plain English, every country has a financial trust score, a measure of political predictability, regulatory consistency, and institutional strength. For decades, America owned that category. This time, the report cited U.S. political volatility, executive unpredictability, and institutional strain. And in the same breath, it cited Canada for regulatory coherence, fiscal discipline, and leadership stability. Those aren't buzzwords, they are signals. Signals to Tokyo, signals to Frankfurt, signals to sovereign wealth funds in the Middle East. Signals that say, if you want quiet stability, look north, and capital listens. Bond markets reacted immediately. For the first time in decades, borrowing costs tightened in Canada relative to the United States. That may sound technical, but it's seismic. The safest borrower historically paid the lowest rate. That hierarchy just blurred. Currency flows tell the same story. In moments of uncertainty, global investors usually rush into the US dollar. This time, the move was more diversified. The Canadian dollar strengthened alongside traditional safe havens. That doesn't mean America collapsed. It means investors are hedging differently. Meanwhile, Canada has been doing something subtle: tightening bank stress tests, aligning regulatory frameworks with Europe, expanding high-skill visa pathways for technology talent, and reinforcing trade partnerships. Not flashy, not loud, but structurally important, and markets reward structure. 3 major tech firms expanding primary engineering hubs into the Toronto-Waterloo corridor wasn't random. It was about predictability. Businesses don't thrive in uncertainty. They thrive where policy is steady, even energy strategy shifted. While the U.S. focused on traditional production narratives, Canada quietly secured critical mineral agreements with European and Asian partners. Lithium, cobalt, graphite, the backbone of the EV and battery economy. That's positioning for the next decade, not the last one. Here's the deeper psychology: money avoids noise. Capital doesn't chase ego, it chases clarity. When policy feels reactive, markets price in risk. When leadership feels measured, markets price in stability. That's what we're witnessing. Not a collapse, not a war, but a repricing of perception. And perception moves trillions. Now let's be clear, the United States remains the largest, deepest capital market on Earth. It doesn't lose that status overnight, but the unquestioned dominance, the assumption of automatic trust, that's what just got tested. And that matters to everyday people. If global investors demand a higher risk premium from U.S. borrowing, interest rates feel pressure. Mortgages, auto loans, business credit. If currency flows shift, import prices adjust. Macro shifts always trickle down. For Canadians, this moment represents opportunity. Stronger currency positioning, increased foreign investment, and expanded global relevance. For Americans, it represents a signal. Markets value stability over rhetoric. And the most important part, this isn't about personalities, it's about systems. One leadership style emphasizes leverage through pressure. The other emphasizes leverage through predictability. Markets are voting, quietly, with capital. So where does this go? 3 realistic paths. 1. De-escalation. Cooler heads stabilize the relationship. Trade normalizes, markets rebalance. 2. Continued friction. Tariffs and political tension push capital diversification further. 3. Structural realignment. Canada deepens economic integration with Europe and Asia, creating a more multipolar North American framework. None of these scenarios mean collapse. but they do mean the era of automatic financial gravity centered solely in Washington is evolving. We're witnessing something rare, a shift in confidence. Confidence is the invisible currency behind every visible dollar. And when confidence reallocates, the world map redraws itself, quietly at first, then permanently. So here's the real question. Is this a temporary fluctuation or the beginning of a broader redistribution of financial trust? Because in global finance, power doesn't disappear, it migrates. And right now, some of it is migrating north. Stay alert, stay informed, because in markets, awareness isn't optional, it's protection.